Let's take a look at Chapter 5, which focuses on unemployment compensation taxes. The purpose of this chapter is to explain the various aspects related to the Federal Unemployment Tax Act, and it details how to calculate federal unemployment tax and the credit against the tax and other credit reductions. So first up, we're going to talk about Federal Unemployment Tax Act, or FUTA as we call it. And this just imposes a tax on employers based on wages paid for covered employment. Funds collected by this tax are used to pay the cost of administration of federal and state unemployment insurance programs. Officers of a corporation are included as employees, and there's some additional covers that I'd like to talk about down here. Now, employers are liable to pay tax if either of the two following tests apply. So the first test is going to be that they pay wages of $1,500 or more during any calendar quarter in the current or preceding year. Again, that's pays wages of $1,500 or more during any calendar quarter in the current or preceding year. The second test is that they employ one or more persons on at least some portion of the day in each of 20 or more calendar weeks during the current or preceding year. So first up, it says employs one or more persons on at least some portion of the day in each of 20 or more calendar weeks during the current or preceding year. Now, some taxable payments under FUTA, some additional things besides just normal pay that would be included under this. Christmas gifts, but this excludes non-cash gifts of nominal value. Additionally, dismissal pay, cash prizes and awards, payment under a guaranteed annual wage plan, and bonuses for remuneration for services. Non-taxable payments under FUTA include retirement pay, courtesy discounts to employees and their families, workers' compensation payments, and the value of meals and lodging furnished to employees for the convenience of the employer. Turning the page. All right, wages and rates regarding FUTA. Taxable wage base for FUTA includes only the first $7,000 of wages paid during any calendar year. The FUTA rate is going to be 6% of the first 7,000 of gross wages for each employee per year. Now there is a credit. It's a maximum 5.4% credit against FUTA allowed for SUTA taxes. So sometimes you might see that it's showing up as 0.6% instead of 6% when you're working on assignments and stuff. That's because you take the 6% minus 5.4, you're going to get 0.6% net FUTA rate. Now we also see in this chapter SUTA, which is the State Unemployment Tax Act. Each state has a trust fund that's financed by state unemployment taxes, and that's what this is. Coverage in general, employers specifically excluded from federal law would also be excluded from state law. And in terms of voluntary contributions to a state's unemployment department, some things that they would, or reasons that this would happen. Companies can choose to voluntarily contribute to their unemployment department to increase their reserve account. And when they reduce their reserve account, what that ends up doing is lowering their contribution rate. Now, in terms of interstate employees, to prevent duplicate contributions on the services of interstate employees, their coverage is decided by the following in order. Okay. The first one is the place where the work is localized. The second is the location of base of operations. The third is the location of the place from which the organization's operations are directed or controlled. And the third is the location of the employees, or fourth, I'm sorry, is the location of the employee's residence. Let's take a look at an example with this. Scooting that up a little bit more. We have Sumatra Imports LLC. They're based in New Mexico. They have a SUTA tax rate of 4.2%, and taxable pseudo wage base of $30,100 for each employee's earnings. During the year, they had FUTA taxable wages of $109,500 and pseudo taxable wages of $298,700. We're going to compute the amount of net FUTA and net pseudo, assuming they are not located in a state with a reduced credit. So to compute the FUTA, we're going to take the $109,500. We're going to multiply it times 0.6% because they do not have a reduced credit, which means they get to take that full credit against FUTA. This is going to come out to $657. For their SUTA, we're going to take $298,700. We're going to multiply it times the 4.2%. We're going to get $12,545.40. Turning the page. Couple additional things in this chapter. First up is Form 940. This is the annual FUTA return. Due date on this is going to be January 31st of the next year. If they are a multi-state employer or they have SUTA credit that is reduced, they will need to attach Schedule A. Additionally, in terms of FUTA, they're expected to have a quarterly deposit, but only if it's cumulatively over $500. Some additional notes on if it's $500 or less. The employer can wait and add it to next quarter. If that tax liability never gets over $500, they'll pay it with Form 940 at year end.